What is happening, everyone, and welcome back to Bitcoin Bulletin, your essential pit stop for the pulse of the digital asset world. The news cycle is absolutely electric right now, and we've got a packed show that you absolutely do not want to miss. We're diving headfirst into the strategies that are paying off, the industries that are reinventing themselves, the incredible demand that's reshaping markets, and the technical debates that could define the future. Get ready for nonstop insights and the information that matters most. Stick around because this is Bitcoin Bulletin. First up, we're talking about a titan of the industry making waves with its unwavering commitment to digital assets. We've got the latest on their bold treasury strategy, how legal relief is bolstering their confidence, and what this means for future acquisitions. Is the on-sale mentality driving even more aggressive moves? You'll want to hear this. Then, we're shifting gears to a fascinating industry pivot. Discover how established players are leveraging their existing infrastructure in entirely new ways, tapping into a different kind of digital revolution. We'll explore the challenges they're overcoming and the innovative solutions they're deploying to stay ahead of the curve. This is a story of adaptation and foresight you won't want to miss. Next, prepare to be amazed by the sheer scale of demand. We're breaking down the numbers that show businesses and institutions are absorbing digital assets at a staggering rate, far outpacing new supply. What does this imbalance mean for the market? We've got the insights that could signal a significant shift. And finally, we're heading into the technical trenches for a crucial debate shaping the future of a foundational network. Developers are at odds over critical updates that could impact everything from data flexibility to network integrity. We'll unpack the opposing viewpoints and what they mean for the ecosystem. It's a deep dive into the core of innovation and governance. So stay locked in for all these stories and more, right here on Bitcoin Bulletin. Don't forget to hit that like button, subscribe for your daily dose of crypto intel, and ring that notification bell so you never miss an update. Legal headwinds cleared, digital asset buys continue. Strategy, a prominent player in the digital asset space, is signaling a continued aggressive approach to acquiring digital assets, particularly following a recent legal victory that has cleared significant hurdles. CEO Michael Saylor has been actively teasing further purchases, reinforcing the company's conviction in its long-term treasury strategy. Saylor recently shared a visual representation of Strategy's extensive digital asset acquisition history via the Saylor Tracker platform, accompanied by the provocative statement, "Bitcoin is still on sale." This commentary is particularly noteworthy as Saylor's public hints have historically served as precursors to official purchase announcements. The market has observed a pattern over the past 3 weeks, with the company disclosing new digital asset acquisitions every Monday, fostering anticipation that this trend will likely extend into September. In its latest disclosed acquisition, Strategy reported acquiring 3,081 units of the digital asset at an average price of $115,829 per unit, substantially increasing its total holdings to 632,457 units, which are currently valued at approximately $68.6 billion. For those interested in tracking these movements, detailed current and historical data is available on the dedicated Strategy Historical Digital Asset Holdings Tracker. To fuel this ambitious accumulation strategy, Strategy has successfully raised $5.6 billion through initial public offerings in 2025 alone, a figure that represents a significant portion, around 12%, of all U.S. listings this year. Despite the capital-intensive nature of this strategy, the company highlights that its stock, MSDR, has demonstrated superior year-over-year performance when compared to the well-known Magnificent Seven technology stocks. A comparative analysis of MSDR's stock performance against the digital assets price is readily available on the Strategy stock price versus BTC chart. Crucially, coinciding with Saylor's recent pronouncements, a class action lawsuit that had accused Strategy of misleading investors regarding its digital asset accounting practices has been formally dismissed with prejudice. This legal outcome effectively prevents the plaintiffs from refiling the same claims, thereby removing a substantial legal risk for the company. This development is anticipated to have a considerable influence on other corporations that are holding digital assets as a component of their balance sheet reserves. By successfully navigating legal challenges while simultaneously signaling an ongoing commitment to digital asset accumulation, Strategy is solidifying its strategic approach. This involves effectively leveraging capital markets and maintaining a robust reserve of digital assets on its balance sheet. The company's ability to secure legal relief while reinforcing its acquisition strategy underscores its confidence in the long-term value proposition of holding digital assets. Hold on tight, the market dynamics are shifting dramatically. Next, we'll explore how established players are pivoting to new digital frontiers. From mining rigs to AI powerhouses, industry reinvention amidst debt. In a significant industry pivot, Bitcoin miners are increasingly repurposing their specialized infrastructure for artificial intelligence, AI, operations. This strategic shift is largely driven by the mounting debt challenges and the declining profitability experienced within the cryptocurrency mining sector. A prime example of this trend is IREN Limited, a company formerly focused on Bitcoin mining, which is now expanding its role in AI infrastructure development. IREN recently finalized a $20 million loan settlement with NYDIG, resolving a protracted dispute concerning defaulted loans tied to 35,000 Antminer S19 units. This resolution marks a critical financial turnaround for the company, especially following a record quarterly revenue of $187.3 million and an annual revenue of $501 million. This financial recovery has empowered IREN to aggressively pursue its AI ambitions. The company's transition into the AI sector is further exemplified by its substantial acquisition of 2,400 NVIDIA GB300 GPUs, with a mix of air-cooled and liquid-cooled models, at a cost of approximately $168 million. This acquisition significantly boosts its GPU capacity to a total of 10,900 units. These advanced systems are slated for installation at IREN's Prince George campus in British Columbia, where a new 10 MW liquid-cooled facility is currently under development to accommodate over 4,500 GPUs. The funding for the GB300 purchase is secured through a 24-month lease with a favorable interest rate in the high single digits, while the B300 units are being financed from the company's existing cash reserves. This strategic diversification not only broadens IREN's revenue streams, but also directly aligns with the escalating global demand for AI computing power. By positioning itself to capitalize on the burgeoning AI economy, IREN is demonstrating a forward-thinking approach to market dynamics. This transformation is not an isolated incident. Hyperscale Data, Inc. GPUS, another entity with a vested interest in Bitcoin mining operations, is also strategically allocating a substantial portion of its recent offering proceeds towards acquiring Bitcoin and expanding its data center infrastructure in Michigan. The company has indicated that the majority of the net proceeds from its at-the-market offering of Class A common stock will be dedicated to Bitcoin purchases and the development of a new data facility. A smaller allocation is earmarked for XRP acquisition and general corporate purposes, which may include the repayment or repurchase of existing indebtedness or capital stock. These diversification strategies are designed to reorient the company's capital structure, increasing its exposure to digital assets like Bitcoin and XRP, and enhancing its overall operational leverage. The moves by IREN and Hyperscale Data underscore a broader industry trend where companies are seeking to mitigate financial risks and adapt to a more challenging market environment by exploring alternative, high-growth revenue streams. The AI infrastructure sector, particularly the demand for high-performance GPUs, presents a highly lucrative opportunity. This is fueled by the exponential growth in machine learning and data processing requirements across various industries. Furthermore, these transitions are occurring against a backdrop of evolving regulatory landscapes. For instance, legislative proposals like the Genius Act, which mandate stablecoin issuers to maintain full liquid reserves and implement stringent anti-money laundering controls, are enhancing the perceived legitimacy and stability of digital assets, potentially encouraging greater institutional support and investment in crypto-linked infrastructure. However, these ambitious transitions are not without inherent risks. Both IREN and hyperscale data face operational, regulatory, and liquidity challenges. Hyperscale data's broad discretion over the allocation of its proceeds and its reliance on future capital raises raise questions about governance and execution. Similarly, IREN's debt resolution and AI expansion plans are contingent upon court approvals and prevailing market conditions, which could impact their long-term stability and investor confidence. Despite these potential pitfalls, the actions of these companies signal a significant recalibration within the industry. As Bitcoin miners navigate market volatility and increasing operational costs, the AI infrastructure sector offers a compelling pathway to diversify revenue and leverage existing technological capabilities. With ongoing advancements in AI and greater regulatory clarity emerging, the convergence of cryptocurrency and AI is poised to accelerate, fundamentally reshaping the digital asset infrastructure landscape and its integration into the global economy. Can this surge in demand create a supply crunch? We're diving into the numbers next. Demand overwhelms supply. Businesses absorb digital assets at unprecedented rates. The pace at which private and public businesses are acquiring digital assets has significantly outstripped the rate at which new assets are being produced, according to a recent analysis by River, a prominent digital asset financial services firm. River's data indicates that in the current year, businesses, encompassing both publicly traded companies with digital asset treasuries and private firms, have collectively purchased an average of 1,755 units of the digital asset per day. This robust demand is further amplified by institutional investment vehicles, including exchange-traded funds, ETFs, which have added an average of 1,430 units daily. Additionally, government entities have contributed to demand by acquiring approximately 39 units per day. Cumulatively, this institutional and governmental demand totals over 3,200 units per day. This figure stands in stark contrast to the approximately 450 new units that are generated daily by miners following the most recent block subsidy halving event. This substantial disparity between daily absorption and daily production highlights a significant imbalance in the market. As institutions and investment funds increasingly opt to hold their digital asset acquisitions rather than trade them, the total amount of these assets available on exchanges continues to diminish. Recent data confirms that exchange reserves have fallen to multi-year lows. This trend exacerbates concerns about a potential supply shock, a scenario that could significantly impact the asset's price if current accumulation patterns persist. Public companies currently hold an estimated 1.3 million units of the digital asset. Strategy, led by CEO Michael Saylor, remains the largest corporate holder, with an impressive 632,457 units. In the second quarter of the current year alone, digital asset treasury companies collectively acquired 159,107 units, underscoring the scale of corporate adoption. Adam Livingston, author of The Bitcoin Age and the Great Harvest, has previously posited that Strategy's aggressive acquisition strategy is effectively performing a synthetic halving of the digital assets supply. This analogy emphasizes how large-scale, consistent buying by major entities can mimic the supply-reducing effects of a halving event. Despite this aggressive purchasing activity, Shirish Jajodia, Strategy's corporate treasury officer, has emphasized that their actions do not significantly impact short-term market prices. He noted, Bitcoin's trading volume is over $50 billion in any 24 hours. That's huge volume. So, if you are buying $1 billion over a couple of days, it's not actually moving the market that much. This statement suggests that the market's overall liquidity is sufficient to absorb even substantial corporate purchases without causing immediate price distortions. However, with businesses, ETFs, and governments absorbing digital assets at a rate far exceeding miner production, analysts continue to issue warnings about a potential supply shock. Such a scenario, characterized by depleted exchange reserves and persistent high demand, is widely considered a potent bullish catalyst for the digital assets price, potentially leading to significant appreciation. Will this imbalance trigger a major price surge? We're now turning to a critical debate about the network's very foundation. Core versus knots, Bitcoin network's future direction sparks fierce debate. A significant schism is emerging within the Bitcoin community. As proponents of Bitcoin Core and Bitcoin, knots find themselves in strong disagreement over the future trajectory and operational parameters of the network. The crux of this controversy lies in Bitcoin Core's planned modification for its upcoming V30 release, scheduled for October 2025. The proposed change involves the removal of the existing 80-byte limit for op return data. This technical adjustment is intended to provide greater flexibility for embedding arbitrary data directly onto the Bitcoin blockchain. However, this proposal has ignited intense opposition from the factions supporting Bitcoin knots. Developers associated with Bitcoin Core argue that lifting the op return data cap is essential for fostering broader innovation across the network. They contend that increased data flexibility will enable a wider array of use cases, including the potential for digital art provenance, secure document verification, and other non-financial applications. Jameson Lopp, a prominent advocate for the core approach, expressed his philosophy: "I truly detest politics. Thus, I have little patience for those who try to impose traditional governance models onto Bitcoin. If you don't like anarchy, you're free to leave." Conversely, supporters of Bitcoin knots, including notable figures like Samson Moe and Luke Dasher, voice strong concerns that this proposed change could transform the Bitcoin blockchain into a repository for non-financial transactions and spam. They fear that such a development would undermine Bitcoin's core identity as a sound monetary asset. Dasher cautioned, "What do you think will happen now that Core is opening the floodgates to spam and essentially endorsing it? Any chance we have of making Bitcoin a success will go out the window, unless the community takes a clear stand and rejects the change." This divergence in opinion reflects deeper philosophical disagreements about the fundamental purpose and governance of the Bitcoin network. The core philosophy generally favors open usage, provided that transaction fees are paid, emphasizing a permissionless and flexible environment. In contrast, the knots perspective prioritizes robust anti-spam controls and maintains a strong focus on network scalability and the integrity of its monetary properties. This ideological battle has led to a noticeable shift in node operator preferences. Currently, Bitcoin knots nodes represent approximately 17% of the overall network. As the release of Bitcoin Core V30 draws nearer, anxieties are mounting regarding the potential for network fragmentation, a contentious hard fork, or widespread transaction rejections if consensus is not achieved. Dasher has specifically raised alarms about a critical metric: the declining usage of full nodes. He stated, "Bitcoin's greatest threat to survival is that far too few people are using a full node. For Bitcoin to work, at least 85% of economic activity needs to do so." This highlights the importance of widespread participation in maintaining the network's security and decentralization. The eventual outcome of this dispute is poised to significantly shape the future evolution of Bitcoin's decentralization model and its consensus mechanisms. The community faces the complex task of balancing the potential benefits of software diversity and expanded use cases against the inherent risks associated with network fragmentation and the dilution of its core monetary principles. Will this technical debate lead to a fork in the road? Stick around as we recap the biggest stories of the day. And that's a wrap on today's Bitcoin Bulletin. We saw strategy securing legal wins and hinting at more digital asset buys, miners pivoting to AI infrastructure amidst financial pressures, businesses absorbing digital assets at 4 times the mining rate, and a critical debate over Bitcoin's technical future. Stay informed, stay engaged, and don't forget to smash that like button, subscribe for your daily crypto briefing, hit the notification bell, drop a comment with your thoughts, and follow us on all our social channels for real-time updates. We'll see you next time.